recorded. Okay, start recording. Session is being recorded. All right, so welcome to the session on, we are still busy with IAS 40, which is your standard that regulates investment property. You will remember investment property is defined as the fixed assets that we own and that we keep for two reasons. It can be both or it can be one of them. And the two reasons will be we want to collect rental income and we want to make sure that we have some or we earn some type of capital appreciation. The fact that fixed assets grow in value, so if you have land and buildings, normally over time you will find that it is worth more, which is called capital appreciation. So if you intend to buy a building and just keep it so that the value can grow and that you can sell it later on, then it is considered to be investment property. Please do not confuse this with what we call speculation, when you buy properties and sell them to make money in the short term. If you want to have your growth be considered capital in nature, you need to keep an asset for at least 3 years. So that's a bit of tax background. You will remember revenue versus capital. So welcome to this lecture, and today we're going to primarily consider what happens if we want to change the nature of the fixed asset. In other words, I have this building and currently I'm using it as property, plant and equipment, my PPE as defined in IAS 16. Now I want to change. I want to use it rather as investment property. So you might find that you no longer need it as a warehouse, you no longer need it as offices for your own personnel. So you're going to change it to investment property so someone else can move into it, and then obviously you will earn some rental income from that. That's a bit of entrepreneurial logic. It can also be the other way around. You might have some investment property, and now the lease that you have or the contract that you have with the tenants is now it has come to an end, and they indicate to you that they are no longer interested in using this building that you have rented out to them. And then you might decide your business is growing and you want to move your own personnel into that building. Or you would like to use that building as your storeroom or as a production facility or whatever. So it is possible to change the reason how to change the, I don't want to say reason, but the category of use of a fixed type of asset. Right, then I like, as always, I have my quotes of inspiration. I like to stay inspired. We all need a bit of inspiration from time to time, especially with online learning. So this was by Albert Einstein. He said, anyone who has never made a mistake has never tried anything new. I love that quote, because when we make mistakes, at least we are growing. I've come to understand in my adult life, and I've not been adulting for very long, but I've come to understand that sometimes when you try something new, you make mistakes and you're the one who ends up in trouble. And those who do nothing, they're never in trouble. So unfortunately, if you are the one making an effort and trying new things, then we make errors along the way, and that is how we learn. And the most important thing is not to feel like a failure, but to go back and to make sure that you understand what you've done wrong so that you do not repeat your mistakes. Then as an introduction, it says there exists a possibility that the intention of use of an asset can be changed. There are two types of changes that can occur, and I've just described them to you briefly, where investment property can become property, plant and equipment, or property, plant and equipment may become investment property. So this set of slides basically shows you what to do in each instance. Right, so let's say you have a change in intention of use and your PPE becomes investment property. In other words, this building is now considered to be an office for your own employees, a room or a production facility for your own business, and now you decide that you want to move it to investment property. Right, so there's a number of steps to be followed that I have set up for you so that you know what to do in terms of your journal entries. So the first thing you would do when PPE becomes investment property is you need to reevaluate the asset in accordance with your revaluation model. So the revaluation model that is prescribed in this syllabi is that you need to be able to do the elimination method or the net replacement method. You will also be familiar with the gross replacement method. However, it is not covered in this syllabi because it is not really applied universally within practice. So when you go to practice, you will find that mostly they use the net replacement value, because with the gross replacement value, you go and look at the price of a similar item, if it's purchased new and then it needs to be depreciated and blah, 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 and it's a whole story. Nobody really does that in the real world. They just use the net replacement value, which is where the current fair value is given to you. So you reevaluate the asset, then you need to transfer the asset, and then after transfer, so after step 2, you will need to fair value adjust the asset at your end, because after transfer, it becomes your investment property. Before transfer, it was still PPE. Right, so this might seem a bit abstract now because, of course, accounting is difficult to teach in words. Accounting is a practical subject where you need to be able to do the calculations. So I've just written an example here, and I've said ABC owns a building, and on 1 January 2015, the building has the following carrying value. So you have a cost of 500,000, you have an accumulated depreciation of 45,000, and the that results in a carry value of 455,000. The building is depreciated over 25 years and it has no residual value. On 1 April 2015, it was decided to reclassify this building as investment property. So before 1 April 2015, this was considered to be property, plant and equipment. Then on 1 April, there's a fair value, and the fair value of the building is 520,000. Ladies and gents, please take note that if I talk about a fair value, it is also the net replacement value. So the fair value is the value for which an asset can be traded today in an arm's length transaction between willing participants. There's a whole definition. I think we did run through it in some set of slides. I think it was last week. So that's the definition of a fair value. And a net replacement value is also the value for which an asset can be sold today or on the date as stated. So that is, in this instance, 1 April 2015. So the fair value of the building was 520,000, which is also the net replacement value. Then they say on 31st December 2015, the fair value of the building is 530,000. Right, so let's see. Then they say require, you need to draft the general journal entries. You need to demonstrate what the PPE note will look like on 31st December 2015, which is then, of course, the year end. And then you need to also disclose what the investment property note as well as the PPE note will look like. In the solution, I have indicated to you the steps. If I say you need to reevaluate, what does that mean? Right. So the first step in revaluation is you need to go and measure depreciation between the beginning of the year and the date that the intention is changed. And if I look at the beginning of the year, it should be 1 January because they ask for notes on 31st December. So obviously, if it's 31st December stated in the required, we know the financial year should run from January to December. Right, so now I need to go and count, firstly, how many months have lapsed before the change of intention, because 1 April 2015 is considered the date of change in intention. So it should be 3 months because it was January, February, and March. Please note how I do not count April, because it's the 1st of April, and we do not account for 1 day in accounting. So it will only be January, February, and March. And if I go back, I just want to go back to the information. They tell you that the cost price is 500,000 Rand and that the building is depreciated over 25 years with no residual value. Please remember, at this stage, it's classified as PPE. So if a residual value was given, you should minus it. If it were classified as at this point as investment property, you would not minus the residual value. So please note that the categorization and the residual value, the way you treat the residual value goes with the categorization. All right, so there was a cost and it needs to be written off over 25 years, and the cost was 500,000. So going back, I'm going to say it's 500,000 for 25 years, and I need to calculate for 3 months, which is January through to March, end of March. That gives me 5,000 Rand. And I do that journal entry by saying I debit the depreciation, I credit the accumulated depreciation. In the next step, I need to determine the accumulated depreciation on 1 January 2015, and then I need to add the depreciation that I've just calculated. So I need to, in this second, or I want to call it second part of the revaluation, I need to eliminate the accumulated depreciation. That's why they call the net replacement value method, they call it the elimination method, because you eliminate all the accumulated depreciation. So that would be the sum of every depreciation that was ever written off, plus the depreciation that I've just added to that account. If I go back to my information, let me just see, there we go. If I go back to my information, you will see the accumulated depreciation on 1 January was 45,000 Rand. And I've just added another 5,000 Rand to this account because I've made a credit entry for it. For this reason, I am going to take out 50,000 Rand, which is the sum of the 45 at the beginning of the year, plus the additional 5 which I added there. If I want to empty my accumulated depreciation, I want to eliminate that account, I need to debit it, because traditionally that's a credit account. It's an account that carries a credit balance. Then I credit, so I write it off against the building, against the PPE building, for which the intention is now changed. So that 50,000 Rand will be a debit to the accumulated depreciation, a credit to the PPE, which is specifically against the building that we are changing the intention of on 1 April. Then I need to go and determine what is the carry value of the asset on the date of change in intention. In other words, I'm going to take the cost price, which was the 500,000, and I'm going to minus the sum of all the accumulated depreciation that I've just taken out of the account. So this 50,000 should correspond with this amount that I have debited here. And that means I have a carry value on 1 April of 450,000 Rand. And if I do that, I now know if I have a carry value, I can know what the revaluation surplus is. Because the revaluation surplus is the difference between the fair value, aka the net replacement value, and the carry value of the asset on the date that the intention is changed. They tell me in the question that on the date of change in intention, I'm just going to go back to that slide again. The fair value, aka net replacement value, is 520,000 Rand. If I now go back to my solution, I will say the carry value was 450. So it's the net replacement value, the fair value, minus my carry value. And it means that there's a surplus. The fair value is 70,000 more than my carry value, which makes it a surplus. If it was the other way around, in other words, the net replacement value was lower than the carry value, then that would be a revaluation deficit. Just please note for the terminology, and of course it's the other way around. If it's a surplus, this is an equity account, ladies and gents, so the surplus will become more on the credit side. Should it be a deficit, you are going to minimize that surplus and it will be lesser. Traditionally, we have an account revaluation reserve. So if it's a surplus, it goes on the credit side. If it's a deficit, it goes on the debit side. And that revaluation reserve is shown in your statement of changes in equity, where you now have it basically as a column, and of course it's then also stated under equity if you do your balance sheet. In this instance, we have a surplus because the fair value is more than the carry value. So we score 70,000 more due to this valuation. And we increase the building, which is the PPE building that we have an intention to change. And then we increase the surplus account by 70,000. All right, so just to recap up till this point, what have we done? We do depreciation first. So we measure depreciation between the beginning of the year and the date of change, and then we put it in the depreciation account. We book it to accumulated depreciation on the credit side. In step 2, or in the second part of this calculation, you need to go and eliminate all the accumulated depreciation. Thus, you need to take the accumulated depreciation as it was stated at the beginning of the year. You add the depreciation that you have just put in that account. You get the total, and the total of all accumulated depreciation that you've ever booked for this asset is eliminated through a debit, and you write it off against the PPE account, of which is the building that the intention is changed of. Right, then we need to go and determine what is the surplus or the revaluation deficit. How do we do that? We measure the carry value against the fair value. Please remember, it needs to be the carry value on the date of change of intention. In other words, the cost price minus all the accumulated depreciation that you have ever had in that account. So that 50,000 should correspond with the debit entry that you've done for accumulated depreciation. You play off the net replacement value or the fair value on that date against your cost price. If the fair value is more than the cost price, you have scored, and that's a surplus. So you book it against a credit entry, and you debit the building of which is still PPE, and the intention is now about to change. Right, should it be the other way around? So your fair value is lesser than your carry value, it is a revaluation deficit. That's what we should do. Calculate depreciation, eliminate accumulated depreciation, measure revaluation, either surplus or deficit. That's the first part. Now you've done all your calculations as it relates to PPE, and now we will get to step 2, where you have your transfer of your asset. So in step 2, you transfer the asset, and the asset is transferred at the fair value on the date that the intention of use is changed. So the date of intention is now 1 April, I think it's 1 April, yeah. And now we're going to say we take out the building, so we credit the PPE building part, and we put that into the investment property account. So we take it out of PPE, we put it into investment property. So please note, investment property is considered to be a non-current asset. So it will be more on the debit side. Of course, the building PPE is also a non-current asset. If we want to take it out, we need to make a credit entry. The credit entry value is the fair value on the date of change in intention. 520,000 Rand as stated. Then we are on step 3, which is the final step, and that is the fair value adjustment. So now, when we get to step 3, this is now full-on investment property. We started with PPE, we transferred it in step 2 to investment property. So by the time we get to step 3, it is now investment property. What do we do with investment property? We do a fair value adjustment if it is not valuated on the cost model. Right, so we need to measure a fair value adjustment at year end. So what do we currently have in that account? We have 520,000 Rand. What is the fair value at year end? If we go back to the question, it's quite a few slides back. PPE investment property. There we go. On the 31st of December, the fair value of this asset is 530,000. So in other words, I have taken it to my investment property account, at a value of 520 because that was the fair value on the date of change in intention. Now it has become 530. So you will agree with me that the value has increased between 1 April and 31st December by a total of 10,000. When the value increases in our investment property, we credit the fair value adjustment account and we call it an income account. So this is profit and loss, and if you do a statement of profit or loss and other comprehensive income, you will state this under other income. And then you will take, of course, a debit entry into the investment property because the investment property is worth more. If we want an asset to increase in value, we book a debit entry. So there's your 10,000 upwards in terms of your calculation. Right, so what would your PPE note look like? So the PPE note will look as follows. We will say all this information was given. There was a cost at the beginning of the year. There was accumulated that gave us a carry value of 455. So I put into my PPE account the depreciation that I've measured. I will put my revaluation, either surplus or deficit. Had it been a deficit, I would put it in brackets or I would type it as a minus and then transfer to investment property. So note how I minus it because I've taken it out of PPE and it has become investment property. So I minus it. It's a transfer to investment property. And you will see it's the transfer again is booked at the fair value on the date of change in intention. Please note also at the end of the year, my balances in the PPE note will now be 0 because I no longer have this building that is categorized as PPE. It is not PPE anymore. It's now investment property. So I can't show it as investment property and PPE, or you could, but I mean, then I don't know, maybe you're working for the Guptas, but generally that's not what should be happening. So it's either one of the two. It can't be both. And in this instance, you've taken it to investment property, so therefore it's no longer in the PPE note and the balances for this asset is 0 at year end. If I should ask you to do the investment property note as it relates to the same transactions that we've just booked, you will see the opening balance in the PPE note will be 0 because at the beginning of the year, which was 1 January, this building was not yet investment property. No, it was categorized as PPE at the beginning of the year, and it became only investment property on the 1st of April. So at the beginning of the year, this balance is 0 because, again, it wasn't investment property. You can't put it as investment property and PPE. Then there's a transfer from PPE. Note how I add it now. So it needs to be contradictory, ladies and gents. If you have subtracted your transfer here, it was transferred to, so it is added here. So it needs to be basically copy and paste. If one is negative, the other will be positive because whatever PPE loses, investment property will gain. Then there was our fair value adjustment income or fair value adjustment upward, which was 10,000. Had it been downward or had it been an expense, it would be in a minus or in a bracket. And then the closing balance was 530 as we had been instructed the fair value to be at year end. So this is what we do when we have PPE and it is moving to an investment property category. So this is the first possibility of a set of questions that I can ask you. The second example of a reclassification or a change in intention is your investment property that becomes PPE. So now it's the other way around. At the beginning of the year, it's investment property. And then somewhere during the year, you decide that you want to change it and now use it for your own purposes and that it will become PPE as it is defined in IAS 60. So how do we do this? So again, 3 steps to follow. The first one is we fair value adjust the asset on the date of change in intention. So now it will be the other way around because first the steps was revaluation, transfer, fair value adjustment. Now it's the other way around. Now it's fair value adjustment, transfer, and then revaluation. So please be aware of that. The fair value adjustment is done to the asset because currently before the transfer it is investment property. So you do a fair value adjustment. It can either be upward, which is an income, or downward, which is an expense. Again, if it's a fair value adjustment expense, it is an item that you will show in your statement of profit or loss and other comprehensive income, and you will display it as an other expense. Then we have a transfer. So you take the asset to PPE. So from investment property, it's taken out to PPE, and then you will do your revaluation as it relates to this asset. Okie-dokie. Then in this example, they tell you DFE Limited owns a building, and on 1 January, the building has the following carrying value. The opening balance as per the investment property is 800,000 Rand. Now we have this interesting, we have the same date of change in intention, which is 1 April 2015. They say on 1 April, it is decided to reclassify this asset and it will become property, plant and equipment. On 1 April 2015, the fair value of the building was 850,000. The building is depreciated over the remaining life of 20 years. Now, ladies and gents, you need to read very, very carefully. Do they tell you that it's the remaining life, or do they tell you it is the total life? Because sometimes we don't have an accounting problem. We have a reading problem. So just keep that in mind. The remaining life is 20 years. I will get to the total life when we do that part of the calculation and explain how it differs. But they continue to say that there's no residual value. And then on the 31st of December, the fair value of the building was 860,000 Rand. And I just made a note here. Please again remember, the fair value is the net replacement value as well. So there's no difference between a net replacement value and a fair value. Right, moving along. Again, required, they ask you to do all the general journal entries for as it pertains to the transactions that I've just described, and then you need to do a PPE note as well as an investment property note. So let's see how it goes. Right, so the first thing you need to do is, at this stage, it's still investment property and we need to fair value adjust either upward or downward. So we need to go and measure what did we have at the beginning of the year and what is now the fair value on the date of change in intention. So the fair value on 1 April is given to us as 850,000. You will notice that the opening balance at the beginning of the year is 800,000, where it's now 850,000 on the date that there is a change in intention, which means it is a growth of 50,000 Rand. It has gone upward. The value is more than at the beginning of the year, which makes it a good thing, which is an income. So I'm going to book that. And I am going to say, I'm on the wrong part of the solution. Right, there we go. So fair value adjust, it's an income. So I credit the income account, fair value adjustment income. I increase the investment property by 50,000, which is the difference between 850 and 800,000. Then in step 2, we transfer to PPE at the fair value on the date of change in intention. So it's 850,000 Rand. I'm going to take it out of investment property. So investment property should be made lesser. With a credit, I'm taking it to PPE buildings. So PPE buildings will be increasing by 850,000 Rand. So take out investment property, copy and paste into buildings PPE. So far, so good, not too difficult. Step 3, the revaluation is normally where we have a bit of trouble. So with the revaluation, we need to go and determine the depreciation at year end. So again, we're going to say we calculate the depreciation, we take out all the accumulated depreciation, we recognize a revaluation either surplus or a revaluation deficit. Now, in this instance, we take, please note, the value that was transferred is now transferred from investment property to PPE is now considered your cost. Please note. Then I divide it by remaining life. They've given you the remaining life. But in a question, I can tell you the total life of this asset was 35 years. Then you need to go and check, when did I first buy this asset? And you need to make a countdown to calculate the remaining useful life. So please take note of that. And I have shared, I think one of the videos that I've shared has that example in where they give you the total life. So do not be confused. Remaining life is the lifespan for which the asset can still be used, right? So if I talk about a total life, I can say the total lifespan of a building is 30 years. However, I've already had it for 10 years, which makes the remaining life be 20 years. So if I tell you the remaining life, it's the 20 years that are left. If I give you the total life, it's the 30 years. So you need to go and calculate how much life we've already used up since the day of purchase, and then calculate, but what are the remaining months? So there's an example in one of the videos, in one of the questions. So please make sure that you can count the months. Many a times I find that students cannot count the months that have passed. If I give them a random date, so I say the year end is 28 February and we purchased this asset on the 31st of August of 2014, and you have to count the months, then everybody gets so confused. So please make sure I demonstrate how I count the differences between the financial years. Please make sure that you're able to count the months correctly. However, in this question, it's easy. They've given us the remaining time span instead of the total time span, so we'll just divide by the remaining. So we take the fair value on the date of change in intention, which is now considered the cost price. We divide it by the total years, and then we times it by for the months that it has been PPE. So you can't depreciate it for months when it was investment property, only for months that it is PPE. So in this instance, I'm going to count. It was the 1st of April, so I could use it for the full of April, May, June, July, August, September, October, November, December. I like to count on my fingers like a toddler, because if I get 1 month wrong, everything will be wrong. So instead of being arrogant and being like, I don't count on my fingers because I'm too smart, I just count on my fingers so that I know I have the right answer, because if I make a mistake here, everything going forward will be wrong. My accumulated depreciation will be wrong. I'm going to use that accumulated depreciation to calculate the surplus or the deficit, which will be wrong. So this is a serious rollover error. That's why you need to be very awake. So I'm going to times it by the 9 months for which it was categorized as PPE, and that gives us 31,875 Rand. Again, I take it to depreciation. The contra account is the credit accumulated depreciation. At this point, the elimination of accumulated depreciation should be very easy, because there was no accumulated depreciation in other years. In other years, it was investment property with fair value adjustments. So there was no other accumulated depreciation than this entry that I've done here, which is 31,875, where I increased your accumulated depreciation account. So please note there can be for no prior year, there can be no prior year accumulated depreciation because it only became PPE in the current period. So therefore, I take out this entry that I've done here, I debit this account again, and I play it off against my PPE building. Then in the next step, I need to know what the carry value is. The carry value is then my historical cost, which was the fair value as transferred from investment property, minus the accumulated depreciation that I have debited in the previous step. That gave me 818,125. Now I am on my revaluation surplus. It is the difference between the fair value at year end, aka the net replacement value at year end, and also the carry value that I've just calculated. So I can see that my net replacement value or my fair value is more than my carry value. That is a good thing. I am making a surplus. So I book the surplus as a credit. This is an equity reserve, and I put it against the PPE building. Had it been a deficit, it would be the other way around. So if the fair value had been lesser than your carry amount, then it's a bad thing, and that would be a deficit account. Again, if an equity becomes lesser, you put it on your debit side. So there's your entry. The difference between the net replacement value and the carry value was 41,875, and I recorded it as a surplus in that reserve account. Right, great. Then what would my PPE note look like? Now I need to remember, this asset was not PPE at the beginning of the year. At the beginning of the year, it was still investment property. And then on 1 April, which is kind of not the middle-ish, but let's just say in the middle-ish of the year, it became a PPE. So my opening balances will be 0 because an item cannot simultaneously, the same building cannot simultaneously be investment property and PPE, right? So at the beginning of the year, it was still investment property, so my balances were 0. Then I demonstrate I transferred from investment property. I got an 850,000 Rand building. Please note again, the transfer amount is recorded at the fair value on the date of change in intention. I show my depreciation, which was the 31,875, which I calculated after the transfer. And then I show my revaluation surplus. Again, if it were a revaluation deficit, you would put it in a bracket or you would show it as a minus. Then the cost price is then 860. Please take note of this. We apply the elimination method, which is the net replacement method. If I talk about elimination, what am I eliminating? I am eliminating my accumulated depreciation. So that balance needs to be 0 because I've taken everything out of that account when I made that entry, that debit entry. There's nothing in that account. So you can't have a balance in that account at year end. So at year end, we show the 860, which is currently in the cost item. So how did I get to this 860? What have I done? Oh, goodness. That is what happens when you zoom excessively. It's almost better. Right, so where did we get this 860 from? It is the sum of the entries that you have posted to that cost account of PPE. So in other words, it is, if we go back, look at the journal entries. So from this point, let me just see, what am I doing here? The cost price is calculated by taking this transfer. So we had 850,000. So you take the 850 transfer. Then you go to the entry that we've done here. You minus this 31,875 because when you eliminated the accumulated depreciation, you had to eliminate it against the cost price of the PPE. So it is that 850. Then you minus this because it's a credit entry into the building. And then you, of course, add your revaluation surplus because if it's a surplus, it increases this account. So it's minus that 31,875 plus 41,875. And that's how you get to the cost price, because in the cost T account, if you can imagine the T account, there was an 850, we minus the accumulated, we added the revaluation surplus on the debit side. So we would have been left in that cost account with 860,000, which is this one. The accumulated depreciation had to be 0 because we eliminated everything that was ever there. And then we had 860 as a carry value because, of course, the cost minus nothing makes a carry value which is equal to the cost. What about the investment property note in this instance? Well, in this instance, we would say at the beginning of the year, investment property, this building was classified as investment property. So the opening balance was given to us as 800,000. Then we didn't have any additions. Additions would be like if you add something to the investment property, like a garage or a storeroom or whatever, that would be an addition. In this instance, we had a transfer. The transfer to PPE. Again, note the opposite. In the PPE note, we added the 850 because this building came into PPE, but it was taken out of investment property. So it is 850 in brackets. We minus it. Then you will remember in our first entry, before we took it to PPE, we had to do a fair value adjustment upward. So this 50,000 that you see there is this first entry that we've done here. That 50,000, that's where it came from. It's displayed now in this entry there. The closing balance should be nothing because it is in PPE at your end. Again, the same building. You need to keep telling yourself that the same building cannot be investment property and PPE simultaneously. For that reason, we need to say at your end it's with PPE. In other words, the investment property part, in investment property, it's now empty. So it leaves us with a closing balance of nothing. All right, so these are the slides that I wanted to run through. Again, I have made a recording that I shared this morning of the set of slides as well, and I'm also recording now. So this recording I'm also going to share. But there are certain steps that need to be followed. And if you do these calculations in an ordinary fashion, or orderly fashion, I beg your pardon, then it's not going to be so hard. But if you are like, I don't know what, in a tumble dryer, round, all right, it's not like that song, you spin me right round. You're not going to have a good time. You're going to have a bad time because you're not going to be able to finish your test. So there's a certain structure to follow. And if you follow the structure, you cannot go wrong. But if you do not follow the right order in which calculations need to be performed, depending on whether we're going from PPE to investment property or investment property to PPE, then you're going to be in a bit of trouble. So I would suggest that you make sure that you somehow just not memorize, but that you remember in which order things need to be done. And before you start your question, I always make, like in a pencil, a note for myself and say, if this is going from PPE to investment property, this is what I need to do. If it goes from investment property to PPE, this is what I need to do. And then if you have a reference to go back to, you kind of feel like, oh, okay, I know what to do, right? So it will give you that relief of, okay, now I need to do this, because sometimes if you read the question and then you're like, oh brother, what is this? And then you can't remember, do I do this first, or then what is the surplus, or should it be a fair value adjustment first? So before you read and you feel somewhat overwhelmed, first write down the steps, because then if you go and read, you remember, oh, this information will go with this step. And then if I see this fair value, it's also the net replacement value, and it will go there with the revaluation surplus. All right, now I have done that, I need to do a transfer. So that gives you a nice framework from which you can work. But I have posted two quite long explanations so far. And then there's also I have a big question that I'm going to share next week as well. I think it is already on Butela, but it's about 50 minutes long. So that one I will share for next week's work. But yeah, so this is the slides that I wanted to run through this evening, and just make sure that you understand the importance of the order in which the calculations are approached. It's quite important for you to remember that. But please go and make sure that you watch the examples, because the questions are very important. This set of slides will give you a good framework of what is happening and what I'm talking about in the explanations. But if you look at the questions themselves, they are very good practice questions for you to go and try out. Right, so that's everything that I wanted to say in this session tonight. Are there any questions? I just want to open the participant. Are there any questions from your side that you would like to ask this evening before I log off? Yes, there's a hand up. You can ask. Please just remember to unmute yourself.
Ma'am, can I ask a question?
Yes.
So what happens when you were talking about the date? So what happens, for example, when they say, what do you call this? Remember you said on the 1st of April, they transferred the PPE to become an investment property. So what happens if they say on the 20th of April? Like when it comes to calculating the date?
The only type of question, or the minimum amount of depreciation that can be calculated will be half of a month. So that's the part that it will affect. So if you are, I just want to open the slides again. So if that tell you that, I'm just going to go back to that slide so that everybody can see. I think I understand what you are asking. It will influence this step. Example, this one. It will influence this step. Because now you will, for example, say, if it is on the 15th of the month or the 16th of the month, for example, you would say it's 3.5 months. So it will be 3.5 out of 12. So it will affect this portion of your calculation. So, and as I said, that's the minimum is half a month. We cannot account for lesser than half a month. I've never seen people in practice, they never take like, oh, it's been 5 days, let's account for it. They just don't do that. So the minimum I've seen is, as you say, if it's around the 20th, they take half a month. But obviously in a question, to be fair, I would say the 15th or the 16th, depending on, is it 30 days, is it 31 days, just to be fair towards you so that you can say, but it was half a month. But generally, if it's around the 13th or the 20th, they book half a month, and that will influence this item here. So you will say 3.5 months out of 12 or 4.5 months out of 12. So that portion will just change, but the rest will still be the same, because now your depreciation will be different, but you will still add this depreciation to existing accumulated depreciation, still take it out, still calculate the carry value, still calculate the surplus or a deficit in terms of your revaluation surplus. All right, have I answered your question?
Yes, ma'am, you did. Thank you.
All right. Anyone else who has a question? No one else? All right, then I am going to log off now so that we can save some data. We have test week coming up for which you will need quite a bit of data. So let's not be nasty. I hope that you have a great week. If you have any other questions that you might come up with when you have watched the videos, you're more than welcome. You can send me an email. You can send me a Telegram message with a photo of the part of the question that you are struggling with, and then I will answer your question. Thank you guys so much for joining this evening, and I hope you have a wonderful week. And if we do not speak before next week, I will see you next week, Wednesday at 6 o'clock, and it will be on Collab again. All right, everyone, keep well.